I would like now to introduce today's presenters. Parul Jain, Practice Director, is a member of the global sourcing team and assists clients on topics related to service delivery portfolio optimization, benchmarking, operational review, and growth strategy. David Ricard, Vice President, leads Everest Group sourcing and vendor management and customer experience management services offering for EMEA clients, as well as select global accounts. Ricky Sundrani, Vice President, is a member of the pricing assurance team and assists clients on topics related to price benchmarking, solution review and contract assessment for IT infrastructure, ADM, and system integration services. And with that, I would like to turn things over to David.
Thank you, Raphael, and welcome everybody. Just as a repeat, based on what Raphael said, if you do have any questions, please do feel free to put it into the Q&A. We'll do our best to address them either during this session or we'll always follow up afterwards. We wanted to cover a few things today, which we're hoping would be of interest to anyone who's got business in Europe, or is looking to do business in Europe and is looking at the region as an area for delivery, an area for basing your business in. And one of the areas that we want to cover, first of all, is around macroeconomic trends, which is impacting the global services industry. We'll then look at some of the key global services challenges that are facing global European organizations. And then we'll try to give you some insights into how to overcome these challenges. So we don't want to just present a bad picture of some challenges. We want to leave you with some thoughts in terms of how you may be able to overcome those challenges. So if we just take a look at the macroeconomic picture on the next slide, please. What we can see actually is that unemployment rates across Europe have continued to remain low. So this picture here shows since 2011, we've actually seen that the unemployment rate has stayed relatively low and has continued to drop. And we're not seeing a big spike post-COVID, which is good news. But what this means is that this, combined with high inflation rates that we're seeing across many European countries, plus the geopolitical uncertainty that we will cover a bit more in this presentation as well, is really causing a real challenge in terms of finding the right talent for European organizations across all of the spectrum of roles that they would be looking for. And actually, this is being compounded. If we take a look at the next slide, this is actually being further compounded by what we're seeing in terms of the labor pyramids and the population by age. And what these charts show actually is, if you look at the chart on the far left, that's a picture of Europe, which is showing that actually we haven't got that many people of working age coming in, or people who are going to be coming into the workforce in the next 3, 5, 10 years. And what that's doing is that's really pushing a force on the talent that we're looking for. What we can see on the other two charts is places like India and Africa actually have a reverse of that pyramid and actually have much more of a greater population who are going to be coming into the workforce over the next 3 to 5 years, which means actually that from a global services perspective, organizations are looking at how do you get access to the talent? Is India and Africa the places that we should be? But also we have to think about, if you need multilingual support for European languages, where you're going to be getting that from. So I think there is a real challenge there that we're seeing in terms of just the macroeconomic picture, the lack of talent due to things such as, say, the population being driven also by higher wages, driven by inflation. So there are some real challenges here. But I think, Ricky, you've got a question that we want to ask the audience.
Yes, thanks, David. Absolutely. I think let's open it up and kind of get some inputs from our guests, right? So we wanted to get your perspective in terms of what are some of the biggest global services challenge you facing right now, right? Is it related to talent? Is the talent more expensive? Are your consumers also expecting increasingly sophisticated experiences? Are you trying to struggle with incorporating some of the ESG goals into your global services agenda, or is it the current geopolitical environment which is making you nervous? So.
Thanks, Ricky. And I think we'll leave the poll open for just a few more seconds, but I think we've got some good participation there. And actually, talent seems to be an issue that a lot of organizations are facing as well. So if we just maybe leave it open for 5 more, 4, 3, 2, 1. Okay, if we can end the poll now, please. Thank you. So what we've seen actually is that one of the areas that's showing the biggest issue, which actually links back exactly to the point that I was making earlier, is around unable to find the right talent. So that's 46% actually of the respondents have been saying that they're struggling with finding the right talent. Talent being too expensive was around 23% of your audience as well. So it's interesting actually, talent and cost of that talent are the two biggest areas that people are challenging with, which is actually great news for us who are presenting today, because most of our content is going to be around cost and talent. So actually, thank you for helping us to be relevant. But one other point that actually is interesting, and only 13% are saying it's a challenge right now, is around the current geopolitical environment is making you nervous. Well, actually, I know, Parul, you wanted to just give us a bit of an insight in terms of our view, in terms of what's happening in Ukraine and Russia at the moment.
Absolutely. And before I get into exact Ukraine-Russia situation, just talking about why this is important, not just for companies with people headcount in those locations, but even broader in Europe region. So nearshore Europe region, this entire region has emerged as a vital global services hub, accounting for about 1.5 million FTEs. And if you compare Europe to APAC, to Americas, Middle East, Africa, this has been one region which has witnessed heightened traction in the last 2 or 3 years. I mean, just last year itself, we saw about nearly 100 new center setups, and in this region continues to be more important. However, the current situation, what's happening is horrific, and my thoughts and prayers go out to people in Ukraine and impacted regions. And we've been closely examining this situation. There are roughly about 50 odd companies, global companies with majority headcount in Ukraine, Belarus, Russia, mostly European, with some American and global companies. Most of them have kind of invoked BCP measures. They're looking at how they can extend support to their own teams, their partner teams, and then kind of keep a tight eye on what and how can they mitigate risk to what an extent possible. From an Everest Group standpoint, if you move on to the next slide, we talk about how companies should look at and how should they think about leveraging these locations from a global services delivery standpoint. I think first and foremost, most of the companies have already kind of invoked their contingency plans, accelerate them, extend support to different parts of your organization. Second thing around cybersecurity, keep a hawk eye on potential threats related to cybersecurity, invest in strengthening the network infrastructure to insulate against potential cyber attacks. And this is not only applicable to companies within Ukraine, also historical evidence suggests that cyber attacks have not restricted to just the conflicted zones, but also spilled over. So there may be some collateral damage in neighboring countries. I think flexing talent and workforce strategy models, this is coming in from a point of view of essentially diversification, which has become mission critical. So think about, we're seeing a lot of companies expanding and, instead of running just 1 or 2 large hubs, they're dipping toes in multiple talent pools, reviewing alternatives across existing portfolios, synergistic portfolios. I think one key point to call out is the growing concern around suitability of the CE region. So we've seen some of the enterprises sensing and expressing concerns with potential expansion of the war beyond the currently impacted regions into the neighboring countries, especially those with NATO membership. So we're seeing some bit of apprehension towards sustaining, expanding services in the CE. Above all, as we've been talking about, I think first and foremost recommendation is to support the teams so that all of us can sail through this safely.
Brilliant, that's great. Thanks, Parul. I think now what we're going to go into is a little bit more detail around some of the key challenges that we're seeing for European organisations, and we're going to look at, again, in a bit more detail, things such around the talent crunch and steeper salaries. We're actually increasing customer service expectations. So as customers of all types are looking for a better level of service from their providers and from the enterprises that they work with, how do you keep pace for that? And then also the constant challenge of increased outsourcing pricing. So Parul, can you tell us a little bit about what we're seeing in terms of the talent crunch?
Absolutely, David. What we have here is the result from our flagship key issue survey. Every year we ask people what are the top challenges they expect to cause maximum disruption as they kind of strategize for the next year. So early in 2022, when we had the survey, one of the key things that came up, and not surprisingly, was talent shortage is the top challenge, right? Especially for European enterprises, we saw that bumping up right from 7, bottom of the table, to top of the table. In fact, most of the organizations we've spoken to are either solving for how do they access the talent, how do I pay the right cost, how do I keep them attracted, how do I keep them motivated, how can I think about boosting their productivity levels. And all of this talent shortage has kind of, spawned across and manifested itself in higher salaries, showing up in higher actual wage increases from service providers in existing contracts, mid-cycle revisions, wage hikes, etc. Yep.
Yeah, sorry, Parul, I was just going to ask the question there, which is to say, and I think you're addressing it already, which is great, but are we seeing this consistently across the globe, or are there particular regions that we should be concerned about? And then secondly, are we seeing it for all skills across outsourcing and services? Or are there particular skills and skills that we should be focusing on, or the audience should be focusing on?
Valid questions, David. I think when you look at this chart, right, we see that the problem is most severe in the onshore locations, especially North America and Western Europe. As we talked about the population pyramid earlier, the problem is here to stay. If not for multiple decades, at least for multiple years in the short term that we see here. Now, within these regions, the shortage or the challenge is more pronounced in tier 1 cities, then tier 2, 3 cities where companies are kind of scrambling to find talent despite availability of large pools. Interestingly, India is also among the top 3 geographies with several severe kind of a talent shortage. And this is despite having a much more favorable demographic mix. We believe the pandemic, kind of accelerated the digital transformation, pent-up demand, enormous opportunities for organizations, and this has resulted in a much more severe challenge, even in a location like India. And to answer your second question, David, around what roles are we looking at? If you move on to the next chart, we drill down to uncover what's underneath, essentially which roles companies are finding most challenging to hire for. In our view, we're seeing that hiring challenges are most pronounced in the IT services segment, and in terms of tenure, it's most common at the mid-level. And no surprise, that is where the biggest raises for 2021 were also reported, averaging about 15%. But the generosity is honestly not limited to just these high demand roles. We've also seen transactional workers receiving an average of 10 to 12% raises in the year. And there's undoubtedly a lot of variables at play here in terms of geographies, industry, scale. But this shows how real the scramble aspect of the talent has become.
Brilliant, thanks, Paul. And I think the other point to remember here, I think, is that, so we talk a lot about talent, and that obviously is a priority for organizations, and having the right people is vital. The second element I think that can sometimes get overlooked is around customers. And I think it's really important to understand that no matter what industry you're in and what vertical you're in, customers' expectations are continuing to grow. And it's not just from a customer service perspective, but it's also how they interact with the brand. It's the type of service that they get, the type of response times that they're expecting. And when we look at what customers expect, we're really seeing that there is a massive demand for digital services and for that hyper-personalization that they expect. So personalization when it comes to knowing about the customer and why they're contacting you, but also to really understand, actually from a personalization perspective, a lot of the time in customer experience management, an area I spend a lot of time working on, it's also about speaking in the language that the customer wants to be spoken in. So it's local language. So thinking about how you service that across Europe is really vital. And I think Europe's always had that challenge, which is we have so many languages across Europe to support. We don't necessarily have the scale of a North America, but we definitely have the complexity when it comes to personalization and language. It's also looking at more proactiveness. It's about providing that ease of use. So automation and self-serve is going to be vital as we start to think about how we can also help customers to self-serve themselves, to reduce the need for people. So there's a connection here between, if we need to reduce the reliance on talent, then actually automation, and we'll cover that a little bit more, can be one of the key drivers for that. Reliability is expected, as you would expect, in terms of making sure that you can interact with a brand in a seamless way, but also around cybersecurity, as Parul was mentioned earlier, is vital as well. And then making it seamless for customers. So I think that we talk about talent and we talk about customer expectations. The third leg to that triangle, if you like, is really around the pricing. So Ricky, I know you're going to cover some of the areas in terms of the biggest movements we're seeing in pricing.
Absolutely. Thanks, David. I think this discussion would be incomplete to not cover this critical aspect around pricing, because especially when we saw this poll come up as well, the second most important issue right now enterprises are grappling with is with respect to the rising outsourcing costs. Now, if we just kind of take a step back for a minute, right, we realize that the services industry has done a remarkable job in terms of keeping prices steady over the last couple of decades, right? So whenever hardships arose, such as look at the 2008 financial crisis, the wage inflation in critical service delivery locations such as India, Philippines, Central Eastern Europe, they've always been offset by increases in efficiencies, automation of IT and business services, and advancements in technologies such as conversational AI and other smart tools. However, this time it's different, right? This rising cost of services is actually driving service providers to increase prices just to stay profitable, right? Just so that they don't go out of business. And this is probably an issue that we foresee many enterprises may struggle with, right? To meet this increased cost of outsourcing. To give you a state of the market, right? The lay of the land, prices have gone up by a good 3 to 5% even for standard generic IT application services, right? Fairly standard commodity kind of work. Even for IT infrastructure services, which is kind of been a stagnant market for a lot of time. Even there as well, we saw rates going up by 1 to 3%. And the specialized IT bucket, right? I mean, that focuses on skill set, which really drives the digital transformation initiatives such as cloud, cybersecurity, containers. They've even seen a bigger, steeper increase, right? With the rates for most digital skills going up by at least 4 to 6%, right? So the key drivers for this, of course, being the growth in demand for outsourcing, the ongoing talent crunch, high attrition, all leading to a high wage inflation, subsequently leading to price increases for majority of the outsourcing services. So, and we anticipate, right? I mean, for our forecast for the year continues to remain in similar ballpark. We anticipate that due to the high market demand, inflationary environment, right? We're hearing of looming energy crisis in the UK and Europe. Prices for outsourcing services will continue to rise this year, right? And for forecasts for the year suggest that for the digital skills, we are expecting or anticipating a 5 to 8% increase in price, as well as even for the more commodity work, we are expecting a price to go up by at least 2 to 3% across most geographies and across most skills. Moving on, if you look at the BPO market, right, the story is largely similar, right? There's no change. However, the quantum of the changes is slightly even higher over here. Even for more commodity work over here, transactional F&A as well, we've seen prices go up by as much as 2 to 4%, and the same forecast is expected to continue for the coming year as well. Now, why that forecast of 2 to 5% seems a bit grim? Because think of what happened in the last 12 months. The 2 to 4% increase came off on a lower base, right? When things in 2020 were suppressed, prices went down, and then we saw a 2 to 4% increase on that lower base. But now the prices have probably gone up to pre-COVID levels, in fact, gone past that pre-COVID levels. Now we're anticipating a further 2 to 5% increase on top of that, right? So which is historical. We've not seen such rate increases coming in onshore markets over the years that we've been tracking this market. So apart from the factors, right, that we discussed earlier related to pent-up demand and high inflation, another factor, right, which seems to be playing out is the pent-up correction in contracts, right? So which has got accelerated by this whole talent cost increase. But even there have been a lot of instances where we saw some legacy contracts, right, which have been negotiated at very competitive rates, but this would be difficult for service providers to sustain in the future, right? So the rate correction is the way to go about it.
Brilliant. Thanks, Ricky. So I think that we've laid out some of the challenges that we're seeing across the global services market, specifically for Europe. And we focused around talent, as you know, which definitely came out as a key theme when we did the quick poll. We've talked about the cost and we talked about increasing customer expectations. So I think that they would resonate with the audience in terms of some of the biggest challenges that they're facing. What we want to do now is just maybe give you some views in terms of how to overcome some of these challenges. And one of the first ones that we're seeing and a lot of interest from enterprises that we talk to is around sort of tapping into those untapped talent pools. And so, Parul, I think you're going to cover what people could be thinking about there.
Absolutely, David. I think the way we've been talking about this, and this has been kind of shaped as we've had so many discussions with C-level execs, is you can solve for the talent struggle by essentially finding hidden candidates across 3 different categories. First one being in your backyard, right? So we have, if you just talk about US itself, you've got 27 million hidden workers in the US who would gladly, capably fill multiple jobs if given the chance. But because of hiring practices, AI-based algorithms, this diverse group usually kind of their applications go directly to the rejection pile. We're seeing, however, a lot of changes in this direction. So the likes of Infosys, other big firms looking to hire from community colleges, essentially rethinking about what their core education requirements are. Also, a lot of firms tapping into the excluded group. When I say excluded groups, these include, people with disabilities, LGBTQs, veterans, military spouses, all of these groups. So think about within the existing communities that you're present, are there hidden workers? Is there an invisible workforce that you've been, not actively tapping into? The second bucket is in your neighbor's backyard, essentially, adjacent pools. Like, for instance, can you think about, developing under-resourced communities, essentially the likes of rural areas in the United States, UK, the urban pool, educated pool, marginalized groups. Can you think about channelizing them into your mainstream workforce? So think about the incarcerated groups, the indigenous communities, the refugee crisis. Can you also think about upskilling the education mix in the locations that you're already present? And the third category is essentially going and tapping into new undiscovered locations, treating the world like your oyster. So think about newer locations, like we're seeing a lot of big tech firms, telecom players moving into Africa. So the likes of Kenya, Nigeria, Rwanda gaining a lot of traction. Within established countries, we're seeing a lot of traction in tier 2, 3 cities, setting up not just for spokes, but also kind of parallel centers to support the main hub location. When we talk about inclusion, I think one of the biggest elements we want to draw emphasis on is the informal workforce. So think about how you can channelize the informal workforce into the formal economy with this shared value space here, right?
Yeah, and Parul, sorry, just to jump in there as well. I think that one of the things that not specifically called out here, but I think is alluded to in quite a few of those bullets is impact sourcing is an area that we cover a lot at Everest Group, and is an area that I know a number of us are passionate about in terms of focusing on that sort of underserved workforce, if you like, those that don't normally have access to jobs. And there is lots of coverage at Everest Group do around impact sourcing if people are interested. But I think that is a great source of talent that we're seeing, especially in locations such as Africa, as people are focusing on there and how you tap into that workforce.
Absolutely, not just in new locations, David, even within the existing locations, there are a lot of marginalized communities, target communities that, it forms part of impact sourcing. So lots of specialists already doing great work there. We'll be talking more about that in our upcoming State of the Market report. So watch out for that one for all those interested in impact sourcing. Coming back to the alternative locations, what we've done here is talked about the first half where you say locations which are, kind of offering great potential in terms of talent, cost, business incentives, favorable environment. And the bottom half talks about the locations where we advise clients to monitor risks because the situation is quite critical. Now, taking Europe, for instance, here, the top 3 locations that we advise: Malaga, Portugal, and Belfast. Malaga, we see more suited for technical skills delivery. You've got lots of brands, Vodafone, BSE, etc. The location offers about 10-15% odd cost savings over Madrid, a quite cosmopolitan talent with good quality life. You're seeing strong government support, good network of universities and business. So we're seeing a lot of traction there. Portugal kind of has built in a lot of positive momentum, both from an IT and BP standpoint, essentially for multilingual services delivery. Belfast offering about 20-30 odd % savings from, compared to a Dublin or a London. We're seeing strong traction, especially from the GBS segment in the last 2 or 3 years. The city also ranks amongst the top mid-sized cities from a business friendliness standpoint. If you talk about APAC, we see a lot of tier 2, 3 locations sprinkled here. Within India, we're saying Ahmedabad, Kochi, Coimbatore, Jaipur. Those are the locations which offer good savings, as well as we're seeing a lot of proactiveness from the government in developing infrastructure, attracting companies to invest in these locations. Changsha offers about 20 to 30% odd savings over Dalian. Fukuoka, we're seeing another small location in Japan, but offers reasonable savings over Tokyo and good from a BPS standpoint. If you move to Americas, seeing a lot of traction, especially I would want to call out Colombia. Essentially, the angle is pivoted around strong cost to talent value proposition. It has always been strong in the BPS side. We're seeing a lot of traction on the IT and digital front as well. In addition to Bogota, we're seeing traction in cities like Cali, Medellin. This is all driven by the improving security situation and also with boosted up English language proficiency here. Jamaica, we're seeing a lot of traction from service providers. Within Canada, Quebec City is offering good potential from not only from an English language standpoint, but also from French scalability perspective. In Middle East Africa, these locations, Riyadh, Joburg, Dubai, a lot of traction from a government standpoint, a lot of investments being made by the governments to attract people. So Saudi Arabia offering green visas to attract tech talent here. When you move on to the other side of the spectrum, the locations where we are advising to monitor risk, essentially the bottom up of the previous slide here. So think about, Ukraine, Belarus, we've already talked about. Turkey, significant challenges related to political instability, weakening currency, etc. In APAC, Jakarta, Colombo, KL. Colombo, high risk driven by political volatility. KL, we are seeing a lot of market congestion, especially challenges in hiring expats. Americas, Brazil, Argentina, Haiti, Honduras, Venezuela, countries experiencing deteriorating humanitarian crisis. Argentina and Brazil, we've already seen, significant challenges around macroeconomic stability, currency depreciation, about 20-25% in Brazil. And Middle East Africa, we're seeing things around Amman has macroeconomic challenges, Abuja as well as point of facing severe business operating challenges here. Now, talking about the locations here. Sorry, David. Yeah, please go on.
So, Purna, I was just going to ask a question actually, and this is a bit unfair probably, so we didn't prepare this question just so the audience knows. So please bear with us. But a lot of these locations are really good for sort of English and maybe one or two other languages. But from an EMEA audience that are on this call, are there any others that you might call out that we should be considering from a multilingual perspective? Because being able to get good English is great, but if you actually need to have multilingual support, whether it's customer experience management or some other activities that need localization, is there any others that maybe we've not got on this slide that you would call out?
Definitely, David. I think one we called out was Portugal from a multilingual standpoint. The other locations are tier 2-3 cities within, say, Romania, the likes of Cluj, Timișoara, or if you're talking about Poland, a lot of location options, Tri-City, Dansk, etc. We're seeing some traction also in like Hungary. So you see PEX, Debrecen, Czech as well. So think about if companies are already in the tier 1 locations, can you look to leverage your brand presence in these locations to tap and attract talent in the tier 3 locations, because they offer the multilingual pool at lower cost. But yes, they would require some investments in terms of nurturing the talent pool, getting them ready deployable.
Brilliant. Thanks. Yeah, and I knew you'd know the answer, so I didn't feel bad about throwing you a question we hadn't prepared. The question that we have prepared for, I guess, but which is sort of, we've talked about the risks and the areas that we should be looking on. What should an enterprise be thinking of doing with this information? So can you share some thoughts on that?
Definitely. I think in order to create a sustainable talent strategy, there are multiple disruptions that leaders need to be prepared on. And we talk about that here. So think about 5 key categories of disruptions, right? Climate change. I don't think this is no longer just a table discussion, but we're seeing more examples, more real examples of companies taking decisions based on climate change. I think a recent example is the Indonesian government's decision to shift its capital city from Jakarta to Nusantara, given the substantial risk from flooding and submergence there. We're also seeing some companies actively evaluating if they want to rethink their business operations there. The impact of demographic shift, we're seeing some locations being more favorable, given the changes in population. So emerging geographies like Indonesia, Nigeria, Zimbabwe, they're kind of poised to gain significantly from demographic shifts. And you talked about those in David, when you talked about the population pyramids. I think piece around the talent, essentially companies are thinking about, can they do a more robust analysis of not just attracting talent, but also managing their entire life cycle. So how is my brand perceived in the market? Do I need to do more in investing and increasing the brand equity? What can you offer, not just in terms of financial compensation, but also non-financial elements. So a lot of thinking and active pushing is going on in different dimensions by multiple organizations. Work from anywhere has kind of helped companies to think about not just confined or refined to one location per se, but can they tap into the neighboring adjacent pools by just maybe setting up one center and tap into, say, the contingent model there, to tap into rural network there, all of them who can work and connected on a shared site basis.
That's great. Thanks, Paul. Just as a reminder to the audience, if you've got any questions, please do feel free to put it into the Q&A. And we'll happily try and sort of address those throughout the session or at the end, or we'll come back on email. Another area that we look at quite a lot in Everest Group is around the actually adoption of technology and automation. And this, I think, is really important to this subject, because as we talk about, there is a shortage of talent, the cost of that talent is going up. Then one way that you can try to address that is actually to look for ways to reduce the reliance on people. And that's either through technology or through automation. And it's important also to call out, I think, on this slide, which is, it's not just technology for the sake of technology, and it's not just automation to do away with people's jobs. But what we see a lot more is it's technology to actually support the frontline workers and the people that are doing the work. So it's making them more efficient as well. So that reduces the amount of people you need, but it isn't just about replacing people with bots. It's more about, how do you improve the end-to-end experience of any activity that they're doing? How do you support the worker? And that's through technology. Automation obviously is also important. And one of the things that we've seen, actually, we did a survey recently, and it was around where do organizations believe that technology could significantly improve the function? And you can see from the results of the survey, then finance is definitely an area where people feel that, and I think what we've seen is that finance is an area where it's can be quite labor intensive. So it is an area where technology could improve that function. You've then got HR, which again is quite a people intensive process. Procurement and sourcing is an area I've worked in for many years, and there's been lots of efforts to make procurement a lot more streamlined and a lot less labor intensive. And I think as buyers, as consumers, we're all used to the Amazon experience now and the one-click experience. And I know procurement functions are really looking to see how they can provide that level of experience to their workers. Contact center, you can see, is also an area where people feel there can be a great sort of influence from technology and from automation, not only to make the customer experience better, but also to make the agent who's dealing with that customer's life easier, taking away some of the day-to-day mundane work and actually making the work they do more interesting. So definitely see across all of the sectors that we talk to, that there is a real appetite to look at adopting technology and automation to reduce that reliance on people. Just one caution probably is on the next slide, which actually talks about the fact that actually, although technology can bring great benefits, and we're seeing that, it doesn't happen overnight. So this slide, and if you look at where the darker orange colors are, that's the time it takes to actually start to see some of the value that's being delivered from these technologies. And it doesn't mean that these technologies aren't valuable, because they definitely are. But what we just wanted to call out is that it's not an overnight fix. It's not going to be something you implement and tomorrow you suddenly start seeing the benefits. So this has to be part of an overarching talent strategy. And you have to think about, okay, where are you going to get your talent from? How are you going to attract and retain talent in the short and long term? How are you going to pay for it in a cost-effective way? But then also, how do you reduce your reliance on talent and people as well? And that's through the technology and the automation. So none of these strategies are taken in isolation. They need to be brought together into a cohesive strategy. I think now what we're also talking about, though, is that pricing, and there needs to be a strategy around pricing as well. So we talked about the talent strategy. We talked about the technology strategy. Ricky, can you share some thoughts in terms of the pricing strategy?
Absolutely, David. I think what we're trying to articulate here is some best practices that we've observed enterprises adopt over the last few months to kind of manage this extreme outsourcing pricing, right? And we've been talking about it a lot, that prices have gone up, shot through the roof, and rates are going up. And so what are some of the best practices that we see enterprises taking to, right? So the first and foremost, very standard, let's assess the as is, right? Figure out where you are against the market, right? Because the price that you signed up for a deal in 2019 may not be correct, right? Or it may be out of sync now. So the first thing is to assess how competitive is the deal already, right? The client may already be paying a competitive, equitable price to start with, or the deal is very hyper competitive. So this way, enterprises need to approach to analyze the as is, where does the deal stand now? Because it's highly unlikely that all parts of the portfolio are at the same level, right? So taking a broad brush approach may be counterproductive. So analyze what are those most impactful areas and then create a plan for negotiation with your vendor, right? The second part is really, we've seen a lot of enterprises push this. Now you've you've gone through the negotiation, you've analyzed your rate cards, you've done all the bits and pieces around that. Now, second part is really to analyze what sort of savings, what sort of automation benefits are you getting from your vendor right now? And the reason why we are still talking about it even in 2021, where automation is table stakes, is because the nature of automation is also evolved, right? What was probably considered very advanced back in 2019 is considered table stakes now. So now we're seeing things like security, automated responses, or the kind of automation advancements we've seen in the last couple of years have been phenomenal, right? So are you as an enterprise seeing your vendor adopt some of these or implement some of these for you? And what sort of benefits are you seeing coming to the table because of this? So you need to really look at, okay, not just what you're paying currently, but what sort of automation impact benefits you might see over the next 3 or 4 years, right? What sort of year-on-year productivity benefits has the vendor baked in your solution? So you need to constantly be on top, question your vendors in terms of what sort of benefits am I getting, what's the ROI for my investments, and who owns the automation platform. So yeah, moving on, then there are
sorry, Ricky, can I just ask, sorry, you're going to hate me as a moderator because I just throw in questions we've not prepared for, but just on the first point of number one, just in your experience, how much, when you do benchmarking for enterprises, are you typically finding that they are paying too much and there's savings available there? Can you give the audience a sense in terms of what you see when we do quite a lot of benchmarking exercises?
Absolutely. So we've seen actually two sides of the spectrum, right? So think of a very large insurance company. Over there, the rates were already so competitive that a price rise had become imperative, right? So the vendor cannot sustain business at those prices. So for them, it was then about analyzing what role levels do I agree to a price increase on. So the vendor had kind of requested for a 20% increase across the board, a 15 to 20% increase across the board. Their next step was to really analyze, okay, what roles is it that we are paying very low, very competitive prices, and there we need to agree to a rate increase. Then what's the quantum of the rate increase? So that's how they created their future plan and the negotiation strategy. However, the other side of the spectrum, there was another company which was already paying, when we kind of benchmark their rates, they were already at the 80th percentile, right? So for them, they really did not need to agree to any sort of rate increases. So we've seen sometimes vendors also being opportunistic on coming up with rate increases across the board, across all the clientele. But to be fair, you need to kind of look at it in terms of what you've already been paying. If you're already at the upper end of the spectrum, you don't actually need to agree to a broad brush rate increase. So that's why this analyzing or benchmarking your as is becomes important to assess, to have a more equitable relationship with your vendor.
Brilliant. Thanks, Ricky.
Some more best practices per se that we're seeing in the market, right? So over the last couple of years that we've seen that the rates for labor rate contracts have gone up, right? Because of the increase in wage inflation and talent cost, supply, demand, and all of those things. However, what we are seeing is that the rate increases in output-based pricing were really minimal, or in fact, in some cases, declined even further, right? For example, for something like network services, network management, due to the advent of software-defined networking or similar things, we've actually seen the effort or the cost to manage network devices has gone down over the couple of years, even though the rates for resources has gone up, right? And this is because vendors being able to leverage, vendors being able to pass on some of the improved operational efficiency and being able to pass on some of those benefits to the client. So from a client perspective, if I'm adopting an output-based pricing model, then it probably nullifies all of those rate increases from me. I'm still paying what I used to pay earlier. The fourth part is really around looking at your spend level analysis across the pyramid, right? Because we've been in a lot of situations where you need to do a spend level analysis, right? How much are you spending at junior level folks versus mid versus senior, right? Because we've seen in the situations where clients have actually, their pyramids have been very skewed. The pyramid is such that they have a majority of the roles devoted to the mid and the senior levels, which kind of really increases the spend that they have with their particular vendor. But not to say that it is not warranted. It may be definitely be warranted depending on the portfolio type, depending on the criticality of the environment. But it's good to kind of reassess and reevaluate as to do you really need that mid-level or a very high, maybe a very senior focused pyramid, right? So you need to constantly have a look at that, analyze your spend across different categories of roles so as to ensure that you are not out of sync. And the fifth part, which is probably gaining a lot of prevalence in recent times, is look beyond services, right? Because whenever we think of rate card optimization, the first thing that comes to mind is, okay, let's just look at the services cost, right? But we've seen enterprises can actually realize more savings out of what they are paying for software services, SaaS subscriptions, cloud spend, software products, right? And different platform subscriptions that they already have. So one such area we've seen in recent times is a FinOps practice, right? So even though FinOps is still at a nascency, yet we've seen some organizations invest into a dedicated FinOps team, and some of them even realize six-figure savings by optimizing their cloud spend. But FinOps essentially, if you go back and look at it, essentially entails cloud cost optimization via optimization of underutilized resources, forecasting future state consumption, and really cross-team collaboration, which will enable you to streamline the solution and the cost that you're getting from a cloud spend, right? So in our view, the spend on software product and licenses alone without the cloud spend can actually range up to 0.5 to 2% of the annual revenue, right? So if you were to just, I mean, this which is significant from an IT spending perspective. So if it is vital to watch for common pitfalls, which usually we've seen come across such as incorrect usage or estimation, audit challenges, what sort of discounts are you getting from your vendors, and what sort of increases pricing are you paying when you talk about renewals. So net, I think number of things that enterprises need to kind of can look at when they are faced with these increased outsourcing costs. I think let's also again have some inputs from our guests, right? So in your experience so far, what sort of measures have you already adopted, or are you planning to adopt to help you overcome some of the global services challenges, right? As we discussed, some of the global service challenges being related to talent, customer expectations, costs. What is it that you've already done or you're planning to do through the year to overcome some of these challenges? Okay, so the polls quickly coming in.
While we get the results, Ricky, what in your experience you've seen is the least adopted measure, which should have been given, most undervalued measure that you see based on your experience?
I think for now, it would still be early stages, but in my opinion, a few early adopters have started investing into a FinOps or a cloud center of excellence or a cloud cost optimization team, right? Because cloud spends have touched millions of dollars in most organizations in the last couple of years, and most organizations have moved to cloud. So this is an area where organizations are going to be very prudent about how much are they spending, what are they spending on, are you getting real value out of the spend that you are putting in. So I think the poll is closed. Yeah, David.
Yeah, no, I think it's interesting. So what we've seen from the poll is actually 62% of the audience have said they increased their investment in automation and AI, which I think is actually goes back to the point we we're making earlier about focusing on technology, focusing on automation. We've also seen quite high numbers, so 40% for leverage untapped talent pools and 44% for leverage alternative locations. So once again, I think the poll is showcasing some of the discussions that we've had. The one actually that surprised me quite a bit, which is quite low at 31%, is actually around benchmarking the outsourcing pricing to manage vendor negotiation. So that's actually a bit lower than I thought, but I'd be interested in, it won't be for today, but maybe that's a conversation to have with people offline in terms of the value of benchmarking pricing, because having in my previous career been in procurement for a long time, you can think that you've got good rates, but you don't, and you can even get a better reduction through negotiation, but you don't know where your starting point is. So you don't know actually if you're still paying more than other people. So quite interesting in the benchmarking one being relatively low compared to the others, but great news in terms of the content that definitely investment in automation and AI echoes what we've been talking about, as well as the focus on talent.
Yep. I think, David, we're here to help, right? I mean, that's where we're trying to help some of our clients in terms of getting started on this benchmarking journey, right? We are offering to do a complimentary sort of a price check for some of your roles focused on cloud, cybersecurity, IT help desk for a few Europe and offshore locations like India. There's a poll come up. If you are interested in participating, please click on that and we'll get back to you.
Yeah, and we'll leave this poll open for a few more seconds, but I think it's spot on, and it's interesting that, say, knowing where you're starting from is really useful when you're going into negotiation. So sometimes that price benchmarking, and it wasn't set up as a sales tool from our perspective, but based on our experience of being in this industry for a long time, knowing what your starting point is actually crucial to be able to get a successful negotiation. So I think we probably can close that poll now, and we've got quite a few people that have asked for follow-up. So we'll be following up offline after the event to be able to follow up on that. Just in the last couple of slides, and then we'll go into Q&A, just want a very brief slide in terms of how Everest Group help our clients. And Everest Group, if you're on this webinar, you probably know a little bit about us, specialist research and advisory firm. We really focus on a number of areas. So we focus in terms of that executive alignment. So being able to help leadership teams to build their strategies, whether it's around their services strategy, their outsourcing strategy, their talent strategy, their GBS strategy. So really aligning with the executives around their strategy. We've talked quite a lot about pricing. So really being able to understand where you're coming from, what you should be expecting, where you're going. Supply diversification. So with all of the geopolitical risk, we've been through the pandemic, and we saw that service providers did really step up well to that. There's been a focus prior to the pandemic around supply consolidation. We're now hearing much more it's around supply diversification, getting the right suppliers to bring the right skills in the right locations. So how do you look for that? And there's an area that we work with a lot of clients on. Skills upgrade. We talk again a lot about skills and making sure you've got the right talent, access to the right talent in the right places. That all links back to obviously making sure you're paying the right price as well. And then that workforce strategy. So what operating model could you be looking at? How do you build a hybrid operating model? How do you leverage things such as gig workers? How do you leverage impact sourcing? These are all areas, again, we're working with a number of enterprises across the globe on in terms of that workforce strategy, thinking about how you leverage that, but also around employee experience as well. If you're going into a talent crisis, then keeping your current talent is also going to be important. So how do you make sure that you retain talent as well as attract talent and look for new sources of talent? So there's a number of ways that we help clients. And I don't know, Parul or Ricky, if there's anything you want to add to that I've not covered.
I think we're good, David. I think just as you mentioned, right, having the right baseline from a pricing perspective, understanding that you're not just operating in a silo. So exploring what other options in terms of locations, in terms of partners do you have, all of these get critically important when you're looking and when you're kind of competing for the same talent in such a critical and more constrained situation right now. So yeah, more than happy to help. Yep. Should we move to the Q&A?
Yeah, Yeah, so there's been a couple of questions coming in. So let me just read them out, and then Parul or Ricky, please jump in. The first one came from Manik, and the question was, you spoke about vendors increasing pricing in order to maintain margins as they face extreme labor cost increases. Do you think the range that you spoke about is good enough to cover the cost supply side pressures? So probably Ricky, that starts with you.
Yes, absolutely. So if you look at an absolute number, it may not be justified in terms of what sort of increases you are facing, right? But that was the message that we were trying to lay out, that you cannot adopt a broad brush approach to increase pricing across the board by a flat 15-20%, because to be fair, you need to kind of reevaluate or assess as to where that rate increase is justified versus where it may not be justified. So we need to take a more fine-tooth approach in terms of definitely, I agree with there are certain skill sets like cloud, cybersecurity, where we are seeing significant wage inflation. So over there, that's why our forecasted increase for the year is also much higher, more closer to 7 to 8% for the year. However, for more commodity skills, we're not seeing that amount of wage, because the amount of wage inflation or rate increases we're seeing is not consistent across the board or by locations, right? For example, historically, we did not see such huge rate increases in the onshore markets like US or UK, but that's changing now. We're seeing rate increases happening even in the onshore market. So that's why the point is that we need to take a more deep dive view in terms of what are your current rates, and then based on that, what should you be targeting to look at based on different locations and different skill sets.
Thanks, Ricky. Another question that came in, and I don't think any of us are specifically experts in this, but I'm sure we can give an opinion, is around automation. And the question was, from Excel macro to advanced AI-based automation, there is a huge spectrum. How do we develop automation doctrine in the org to find which automation toolset is best for what level or area of automation? I'll take a stab at that if you like to start with, and you guys can jump in. I think that in my experience, it isn't possible necessarily just to have one org-wide doctrine in terms of this is what we do for automation. Where I've seen it work really well, working on a number of consulting projects before joining Everest Group, is to look at it by function basis and do a real deep dive analysis in terms of the functions that are being done in that area. And then line by line identifying which ones are ripe for automation and what level of automation. And is it just an Excel macro, or is it actually going and buying a third-party solution for that? So I don't think I've not seen work well trying to do it across the entire org and saying automation is going to be the answer, but looking at it by process, function by function, identifying which functions are going to best to be automated, have the best return on investment, have the least negative impact on customers, most positive impact on customers if possible, and then identifying, okay, what's the solution for doing that? So driving it by process. But Parul or Ricky, do you have anything to add to that?
David, absolutely right. In fact, even securing the budgets for doing mass scale automation is going to be difficult. So doing it on a small pilot by pilot use case basis helps in securing the budgets as well. So at the same time, trying to do everything, or trying to boil the entire ocean at once will take longer time. So you miss out on the bus. So definitely time is of the essence. Speed is key. Keep doing small things, see what works well, what may not work well, what are the learnings, and keep deploying that so that you get the best outcome.
And just to add, I think as is the case with any sort of transformation program or technology implementation program that we've seen, usually a very robust adoption and change management program needs to ensure that, that should be in place beforehand to ensure that the implementation of the transformation is successful. So that's something that we've learned over the years talking to a lot of clients, is that automation also is as successful as your employees are able to make use of it, right? So it needs to be accompanied with a nice adoption and change management program along with it.
Brilliant. Thanks, Ricky. And then one last question, I think, before we do close and go into the final offer for the audience, which is just, how does the current crisis and disruption in Ukraine and the neighbouring areas impact the supply side situation? And does that lead to some delay in being able to push through price increases, at least in the near term? So maybe, Parul, you can start with you.
Yes, David, absolutely. The current crisis does put pressure on the supply side. We're seeing locations, the neighboring countries, etc. All of them, companies that are trying to think about what are the best options where they can, transfer some of the work, keep the lights on. A lot of refugees moving into other Central Eastern European locations, potentially see if there is an opportunity to tap into those pools, kind of get that area. We were seeing a lot of questions or thought processes coming around. Hey, can I leverage? Can I increase the leverage of India and LATAM from a talent pool perspective to just ensure they're in different time zones? There's diversification there. Ricky, do you want to comment about the price increase capability for the short term here?
Yeah, I think there are two count points to it, and we've been having a lot of discussion in recent times. So one is that what will happen is a lot of people will move to Poland, and then what will happen in the neighboring countries. What will happen is, because of the supply chain disruption, more mouths to feed in these neighboring countries, inflation is going to remain high, or is in fact is going to increase further, right? So which will lead to some sort of a pressure or rate increases in the services market as well. However, the counterpoint to that is enterprises may be a little jittery in terms of moving work to some of these locations, which may actually cause a cool down in demand as well. They may be more comfortable moving some of this work to India or Philippines rather than moving it to Eastern Europe, right? So that's something of a work in progress. We're still evaluating how the situation plays out. However, if the first scenario plays out, then probably yes, they will definitely start seeing some rate increases coming through Eastern Europe as soon as the next 6 months.
Thanks, Ricky. And so I think if we just move on, we've got 1 minute left or 2 minutes. Just the last offer that in terms of taking part in a virtual roundtable. We are actually looking to do a virtual roundtable in terms of focusing on contemporary sourcing best practices and its impact on outsourcing spend. And so I think, Ricky, I think we can offer people a chance to take part in that.
Absolutely, David. We love to get more opinions, get more thoughts, and learn about how organizations are able to improve their sourcing rigor with it by adopting some contemporary best practices, and how has it really impacted the overall outsourcing spend per se.
Great. Yeah, we'd encourage you to sign up. I think the poll's going right now for the audience, and obviously a number of people have signed up, which is great. It's always good to have a chance to hear from your peers, and it's not just us. We'll facilitate the session, but you'll get to hear from your peers in the industry and what they're doing. And in my experience, I always found it really interesting to hear what other organizations are doing, and you can either learn from them or you take comfort in the fact that you're not behind everyone else. So that might sound quite selfish, but I always found that quite useful to realize that you're not behind everyone else as well. So if you are interested, then please let us know. But thank you for your time, everybody. We appreciate we're at the top of the hour pretty much by a few seconds. So I'd like to thank everyone for your time today, and thanks for listening. And you've seen our contact details on the slides. If you have any questions, and as said at the beginning, everyone will get a copy of these slides or a link to download the slides.